Good afternoon and welcome to the SYSTEM1 Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Simply click on Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to James Gregory, CEO. Good afternoon.
Good afternoon, everyone. Thank you for joining us today. Today is all about sharing how we are building momentum here at SYSTEM1. I will provide some highlights on performance, diving into the revenue and also the strategic initiatives. I'll then hand over to Chris Wilford, our CFO, who will cover off the financial KPIs, our cost base and our cash. And then we'll close with time for any Q&A at the end. So to start with the highlights, H2 platform revenue was strong, coming in at £9.8 million, 29% up on previous halves, platform revenue of £7.6 million. These two combined led to a full year platform revenue of £17.4 million, up 40% on the previous year. Gross profit margin was good, improving to 84.2%, with operating costs 1% lower than the previous year. We actively invested £4 million cash in our platform, our products, and our IP. As part of this, the TYX platform is fully automated across our 3 product groups. The US IP litigation was settled out of court earlier this year, and we'd also pick up on our cash position, which ended up at net cash of £5.7 million at year end. So to start with, we all know that marketing is one of the largest areas of investment for many businesses. But we also know that it's not always well done. Half of all advertising spend is wasted and 80% of new products fail. So that's where we come in. SYSTEM1 is a marketing decision-making platform that helps marketers create world-class advertising, innovation and brands. And we do this by providing our customers with predictions and improvements to increase the return on investment on their marketing decisions and ensure they translate into profitable business growth. Underpinning this, we have a very clear customer offering. Firstly, we predict how well our customers' advertising, idea and brand will perform across the full breadth of the marketing funnel. That's the blue box you can see labelled Predict Your or Data. We then help our customers improve their advertising, their ideas and their brand through our Improve Your data-led consultancy, the yellow box next to it. These two are iterative and our best performing customers do both continually. And then in the third box, we retain the ability for bespoke consultancy, which allows us to help customers transition from what they're doing today to where they should be in the future. This is a small part of the offer, but critical to onboarding new customers. And for clarity, our growth engine, focus and investment is in the Predict Your and Improve Your offerings. To support this, we've fully built out a platform that delivers all of the Predict Your offering for data products, as well as some of the Improve Your offering where possible. This end-to-end process used to take multiple days and weeks across multiple teams. With significant investments over the last few years, we reached full automation in the last financial year. And this automation allows us to offer predictions at market-leading speed in under 24 hours. And more importantly, it removes the need to add in operational costs as we scale the business. The platform also operates as a results platform for our customers to receive and view their predictions and improvements. This has been built out with high quality user experience to set out actionable results for our customers. And this is fully interactive and self-serve, meaning that our customers can access their results directly. And moving on to last year's results, we're relentlessly focused on delivering continued quarter-on-quarter, half-on-half and year-on-year growth. And this is going to be powered by our platform offering, which is now 74% of total revenue. In the charts here, you can see in the blue that our data, our Predict Your revenue grew 44% year on year. And the data-led consultancy in yellow grew 23% year on year, totaling a total growth of the platform at 40%. On top of this, we've seen momentum within the year and a strong second half. So half one growth came in at 34%. But half two growth was up at 45%. Alongside this, we've focused on retaining bespoke consultancy revenue and customers. On the chart here, you can see some very small growth in H2 over H1 last year. And we aren't planning to grow this, but what we are looking to do is to retain the revenue or to see a slight reduction in where this will be. And then when you put these two together, what you can see is the combination of platform growth and the bespoke consultancy revenue retention means we've turned the tide and we're demonstrating total revenue growth. You can see in the chart here, this particularly came through in the second half of the year, where we were 23% up year on year and 10% up on half in the previous H2. Underpinning this is our Predict Your products. The Test Your Ad, which is the dark blue bottom aspect of each of these bars, grew by over 30% year on year. It remains the star product and a strong base for us to grow from. And for reference, this was the first product we built out, which is partly why it has such large revenue compared to the others. Test Your Brand, which is the middle bar, the middle parts of the bar, had the strongest growth with over 120% year on year growth, big wins in the US and in LATAM. And Test Your Idea, which is the top part of each of the bars, was the most modest at over 20%, but remains an untapped opportunity for us to grow in the future. Our ambition is for all three of these to provide similar levels of revenue in the future. So we should look to see this continually grow, but also grow within each of those products. Our Test Your Ad premium database is our most valuable asset. So this is where we continue to test almost every ad that airs across the US and UK within 24 hours of airing. And we grew the database by 13% in the US and UK over the last year. Why is this important? Well, firstly, it allows our customers to remain at the front of their category and industry as they're able to view both their adverts in real life, but also those of their competitors. And it also powers our predictiveness and the IP of our platform offering, underpinning all of our IP and thought leadership. And the great thing is, on top of this, we've continued our ability to sell this to our top customers and commercialize the premium database. As we consider the cost of the premium database as an ongoing cost of the business, what this does is it brings in highly profitable growth from subscription revenue with essentially little to no additional cost. Last year, we saw high levels of new customer growth, 18% up year on year, which in turn drives total growth up 9% year on year. The new customers you can see in this bar in the dark blue charts. However, we know the retention of our new customers is key. So if you look at the bottom part of each of those bars, the light blue, what you'll see is it's relatively flat from a retention perspective. There are two reasons behind this. Number one, we're still seeing the legacy of our bespoke consultancy customers who've been leaving year on year. But number two, we also need to do a better job of ensuring that our new customers who are coming in are retained and are sticky going forwards as well. So if you look at this bar going forward, I'd expect to see the light blue grow and the dark blue also continue to grow on top of it, increasing the overall level of number of customers. So over the last year, the board led a strategic review and we said we'd focus on what will make the biggest difference to growth of the business. We highlighted 6 areas of focus within this. Firstly, that our USP is predictiveness offered at market-leading speed and value. Secondly, we will increase our product coverage across the full marketing funnel, including digital. Thirdly, we'd target the world's largest advertisers, and through that, we'd also scale through partnerships. Fifthly, we'll win in the US, and then finally, we'll be customer-led without bespoke customization. On the last one, as this is one that I don't have such good slides on, just for clarity, what this means is rather than selling just an off-the-shelf product, it'll be more akin to the automation industry, where you can buy a standard scalable product, but you might be able to choose the color of the car, for instance. So we're clearer than ever on our USP, which is predictiveness. We're the only company who can translate emotion into business results, but we also need to compete and ideally lead on speed and price too. This is fundamentally important as we're targeting the CMO and the C-suite, something our competitors can't do. And this predictiveness is underpinned by large-scale IP, methodologies and technologies. We've tested over 175,000 ads, brands and ideas through over 12.5 million surveys. We've measured over 27 million emotions through our face trace technology in over 75 markets. We've also created incremental revenue opportunities by finishing to build out the Test Your Ad suite. Within this, you'll see on this chart that we've launched Test Your Ad Digital and Test Your Ad Audio over the first quarter of this financial year. When you look at those for clarity, the audio would cover things like radio, but also digital products like podcasts. And under Test Your Ad Digital, this is a really key offer for us. The incremental opportunity here is for us to tap into the digital market of advertising, which is over $477 billion of spend last year and over 60% of global ad spend. And as we've launched these new propositions, we've accelerated our partner strategy. The new additions you'll see on this chart include Finecast, Pinterest, Teads, and JC2Co, and more to come this year. We have two clear roles for our partners. Firstly, our partners help us amplify our fame and increase credibility. For example, if you look at our recent launch of Test Your Ad Digital, partnering with Pinterest allows Pinterest to promote this and add their credibility and their fame to our product. Secondly, it provides direct access to customers at scale. We have a very warm introduction from each of our partners to their full customer base as they look to partner with us going forwards. And I'll bring up a slide here which allows one of our partners to bring it to life for you. So this is John Lombardo. He's the head of research at the B2B Institute at LinkedIn. And what he said was, poor branding alongside creative that is unlikely to be remembered is perhaps the single biggest source of waste in marketing. Working with our partner at SYSTEM1 helps LinkedIn ensure our clients produce ads that are not only well branded, but also emotionally engaging, maximizing the chances that the brand is remembered and minimizing the risk their competitor is remembered instead. Every smart CFO should mitigate risk by having her marketers test their ad first, generally the biggest line in their marketing budget. We're also very clear that we want to target the largest advertisers in the world. Unfortunately, due to our contracts, we're not always able to name them, but on the slide here, you can see many examples of those who we may work with. For us, this is all about focus and proactive engagement. And the upside to this focus is that by winning with the world's largest advertisers, we'll also attract medium and small-sized businesses too. We're also really clear on how our customers buy. I'll take a moment to explain the chart on here because this is quite critical to our offering. In the middle bar of the chart, you can see that 78% of our revenue comes from customers who buy data and consultancy. So this is the Predict Your, the Improve Your, and the Bespoke consultancy revenue we talked about previously. So 78% of our revenue comes from 40% of our customers, who on average are spending over £150,000 per customer. On the left-hand bar, you can see our data only, so our Predict Your offering. So 12% of our revenue comes from customers who only buy data, and this comes from 46% of the customer base. That's an average of 20,000 per customer. And then on the right-hand side, you can see 10% of our revenue coming from customers who only buy consultancy. This tends to be legacy customers who buy mainly the bespoke consultancy, but this does come at a higher price at over £50,000 per customer. So the reason we're really clear on how we want to grow the business through the combination of our Predict Your and Improve Your offering is shown here in the revenue we make and the size of business we're winning from our customers, as well as being really clear in the voice that comes from our customer base. And also wanted to call out that our top 10 customers accounted last year for 35% of our revenue, and the top 20 customers, 54% of our revenue. As I mentioned, it's difficult when we aren't allowed to name any of our customers, but I'll allow you to just look at the chart here briefly to see some of the recent wins come to life. There are a few who do allow us to quote them, and you'll have a couple of quotes that we'll explain to you right now. So the first one comes from a company called Boston Beer, a big US-based company, and they're talking about the adverts they've been building out for the Super Bowl. They said, "We believe in the value of testing early and often, especially with such a wide-reaching campaign like a big game commercial. SYSTEM1's platform is incredibly efficient and effective at predicting the success of our creative and identifying areas of improvement." And that was Layla Lisi, the CMO of Boston Beer. And then one here from the world of Test Your Idea, where Becca Hansen, the brand manager from Dorset Cereals, said, SYSTEM1 helped us better understand which muesli idea could evolve into a marketable product with additional work from our internal teams. It's been wonderful to see our idea come to life on supermarket shelves. And then finally, from me, before I hand over to Chris, we're continuing our focus on the US. It remains the largest opportunity for growth, and we have 3 areas of focus for the year. Firstly, we need to continue to build out our fame in the US, where we are less known than we are in the UK and Europe. We'll be targeting big events to be able to help support this, such as the A&A, which is the biggest marketing festival in the US, the equivalent of Cannes Lion that we see over here in Europe. Secondly, we've appointed a US advisory team with John Bond and Noah Breyer in place, and more to come. Both John and Noah are very well known in the US as leaders in the space of marketing, and will continue to promote us as well as provide introductions directly to customers. And then thirdly, we've increased the volume of heads in the new business team. We know in the US what we need to do first of all is win new customers and fill the funnel, which will get us to translate into revenue in the future. And what's good alongside that is then we're seeing many new wins come into place. Again, unfortunately, I'm not able to name them all, but there's a few here you can see on the chart. And if I was to call one up, for example, if you looked at the top 10 Fortune 500 company in the space of oil and gas as a recent win. And you can see on the bottom line as well, a very exciting US pipeline of people who we are piloting and in current conversations with. Super. On that, thank you for your time, and I'll hand over to Chris Wilford, our CFO.
Thank you very much, James. As James said earlier, it's been a year of 2 halves with, as we guided at the outset, growth and profitability concentrated in the second half, and in particular the final quarter, and in particular the final month actually of the year. So it got better as it went on. Revenue from the platform up 40%, more than offset by a 48% decline in the bespoke consultancy product set. We managed to widen the margin a bit, so gross profit was down just 2% versus total revenue down 3%. And we kept a very good handle on operating costs, and I'll come back to that later on. So the adjusted and the statutory profit before tax were well aligned, both about £200,000 down on the prior year. And that was due entirely to the lower revenue volumes that James has described. So I'm now going to review the financial KPIs before we drill down a bit into SYSTEM1's cost base and cash flow. And we refreshed our KPIs that you can see on the page here after the strategic review to ensure that we got the right balance between the growth that James has been talking about, the return that you shareholders are looking for, and cash generation. I won't dwell too much on the revenue KPIs because James has already cantered through those. So the gross margin ticked up to 84.2% versus 83.8% in the year before, proving that the platform products do not dilute that measure. In fact, in the period, the gross margin percent on both the platform and the non-platform products was exactly the same at 84.2%. And the gross margin is really important in a business like ours that's looking to grow, because as we scale, give or take a few percentage points, the gross margin is the marginal profit that goes through to the bottom line. Adjusted EBITDA and adjusted margin moved down slightly in line with the revenue and the PBT. And our rule of 40 measure, we beat the benchmark of 40. And for those of you who aren't familiar with this measure, it's very popular with tech and SaaS businesses. It is the sum of the revenue growth percent and the EBITDA margin percent. And in our case, because we're focusing on our strategic revenue, the platform revenue, we use just the platform revenue growth percent, and we apply then the total group EBITDA margin percent to that. So it's 40 plus 8 gets you to 48. And looking forward, obviously the benchmark we're looking for is 40 or better, but looking forward, I'd expect the revenue growth percentage to typically be slightly lower than 40%, but hopefully well into double digits. But the good news is we'd expect the EBITDA margin to improve over time, up from single digits to double digits. Free cash flow fell off markedly versus the previous year, and I'm going to explain that in more detail in a minute, but clearly a move from plus 2.5 to minus 3.1 can't pass uncommented. And then finally, the net cash in the business is still very positive. So at the end of the previous year, we had net cash of 8.7, which was gross cash of 11.2, less 2.5 million of debt that we had at the time. And during the year, we paid off that debt at the beginning of the second half and ended the year with 7 million of cash and net cash. So still a financially very strong and stable business. Oh, sorry, James has already advanced the slide kindly, so let me go back to that. On this graphic, I'll start with the statutory costs on the left. So these are the costs that when the report and accounts come out in a couple of weeks' time, you'll see the total costs statutory are 22.9 million. And there are three big chunks within that. The first chunk is the 3.7 million in Fuchsia Pink there. That's the direct cost of the difference between revenue and gross profit. There's a second chunk in blue that is other costs, mainly non-staff overhead costs. And then the chunk I want to talk about first is the yellow 12.9 million. That is the staff costs. And they're called employee benefit expenses in the notes of the accounts. So on the staff costs, you'll see on the right that 39% of those costs are sales and marketing costs or customer acquisition costs. And this is just effectively the staff salary and related cost elements of that. So nearly 40% of our staff overhead is in that area. And that's grown over the last 2 to 3 years. Currently, IT and operations both represent just under a quarter of those costs. And looking forward, we expect IT to come down a bit. So we've really ramped that up over the last couple of years as we've developed the TYX products and the platform. And we've reached and just past the peak of that. I'll explain that in a bit more detail in a moment. And then we've got, perhaps you might say, a surprisingly high 16% of admin costs, and that probably reflects just the size of the business. So the admin costs and the group central costs are a high proportion. And again, that should come down as we scale. And those admin costs include the costs of the board and the executive directors, including James, John Kieran, and myself. So as we grow revenue, admin, IT, and operations will require few, if any, additional heads. And it's the headcount that drives the salary. The sales and marketing overhead will grow, but at a much slower rate than revenue. So that's just emphasizing this is a highly operationally geared business that is scalable. And so the economics as we go forward and grow should be attractive. Just putting those staff costs in the context of the previous year, on the left of this cluster, so the pink bars are financial year 22, the yellow bars are financial year 23 that we're just reporting. You can see there the big growth in sales and marketing staff costs year on year, the small growth in IT staff costs year on year. And the big growth in sales and marketing was absolutely deliberate, and we will likely see some growth in the current year over last year. So that trend will continue, probably at a slightly slower rate. On IT, the growth that we saw financial year 23 over 22 was really the full year effect of the decisions that we took during financial year 22. So we didn't have more people in financial year 23, we just had them for the whole year. And so we won't see much, if any, growth in FY24 over FY23, and we might see some falling off. We've also got quite big non-staff costs in IT. So we've got some developers who aren't employees, and that's typically the first group that reduces before we look at our own staff costs. And then finally, operations and central, as you see, they didn't really budge, and we're not expecting those to grow. We're not saying that they're going to grow because that's the whole point of our operational gearing. And then finally, I'm not going to talk too much about these. It's just the balancing number. And what I've done in this graphic is broken out the 6.3 balancing figure. Now, in that 6.3, there's actually a net minus 1.2 that comes from some negative numbers due to the capitalization of some development costs and some FX translation credits. So I've ignored those in analysing the remaining things that are sort of more under our control. And you'll see that there are a lot of these costs are actually the establishment costs, the costs of having an entity in a company, such as property and the corporate centre costs. And frankly, some of those IT costs, which are about the infrastructure of our networks and our software and the software we use to run the business as opposed to the software that our customers use. And then there are some within the operations, including test your ad database, that bottom left slice, about £1 million is spent on maintaining, growing the test your ad premium database that James mentioned, and that will continue to grow. So that's the one element in this area that should continue to grow with the growth in the business, but the rest of it again is pretty fixed and shouldn't grow at all. In fact, property over time should come down a bit because we still own 1 or 2 buildings that are bigger than we need, and those leases come to an end in a year's time. So nature of the business, highly fixed costs, and as soon as that revenue line starts to move, we should start to see better profit and cash generation. And then finally, a few words on that negative free cash flow, and I hope you appreciate the additional disclosure on this year. So at the top of this rather busy chart, there's a waterfall chart that shows how we get from our statutory profit before tax of 0.7 million to our free cash flow of minus 3.1 million. And it's basically adjusting for things that are in the profit which are non-cash, such as share-based payment and capitalization, and things that are not in PBT, such as the change in working capital and interest and cash tax. And the two numbers that I'd highlight in the yellow flying bricks between the profit before tax and cash flow are the receivables. So our debt or debtors, which increased by 1.7 million year on year. And you can see the absolute numbers in the middle of the bottom of this chart. It went up from 4.5 million to 6.2 million. And to put that in context, the 4.5 million figure from the previous year end, you can actually see that in the fuchsia colored line in the bottom right of this chart. So we had a very low level of debtors at the end of the previous financial year. And that was mainly because the sales were really disappointing at the end of the previous financial year, which is one of the reasons we had a profits warning in that quarter and we lost a lot of our US sales force. So that's what explains the increase in receivables that impacts the working capital, that impacts cash flow. And the second element was the fact that having not capitalized the development of the individual test your ad, test your brand, test your idea products, we decided when we built the platform that straddles all of them and gives functionality to us as a company and our customers to self-serve, we felt it was safe to capitalize that because the functionality and the benefit was spread over 3 different product areas, so it wasn't reliant on one succeeding or failing. And the net impact of the capitalization and the amortization in the year was 1.1 million. So effectively, if we hadn't capitalized that, the profit would have been 1.1 million lower, to be really specific. And because we went from 0 capitalization or effects to that 1.1 million effect, that will taper off over the next 3 years because we're amortizing the costs we've capitalized over 3 years. And so next year, the impact will be, say, 500,000 less, and the year after, another 500,000 less. And the year after that, there'll be no net impact of that. So it's a very noticeable in the year just reported. And when you add together the big change in receivables and that capitalization, it does explain most of the 3 million negative cash flow. I hope that is clear. And the other point to make is that primarily because of the improved performance in underlying revenue and gross profit, the cash flow was a heck of a lot better in the second half than it was in the first half. So first half minus 2.7 million, second half minus 0.4 million. And we're seeing the sort of seen from the revenue statistics that we've published already, the Q1 revenue this year was good at a level where you'd expect us to be profitable, and we're seeing good or encouraging cash flow trends in the current year. So the current year, you should expect us to be broadly cash neutral, to be profitable and broadly cash neutral, as opposed to being profitable and very cash negative last year. And by cash neutral, I mean plus or minus £500,000. That's the kind of range you're in. And if you've seen the Canaccord report that came out earlier in the week, I think they're calling it minus 0.3 million, which seems reasonably sensible. That's not our number, that's their number, but we're saying cash neutral. And then after the current year, as I've signalled, we should revert to earnings being pretty well aligned as they have been over the years. So that's all I wanted to say to you on cost and cash. You may have some questions, but in the meantime, I'll hand back to James.
Thank you, everyone. So just like to finish off with a brief summary before we go into Q&A. Firstly, the growing platform sales momentum is in place. We've seen that in particular over H2 last year and carrying forward into H1 this year. That we have a relentless focus on the execution of the strategic plan. It's really important for us as we go forward. We have a customer focus, and we're targeting the world's largest businesses. We're doing this through new product channels amplified by partnerships. We continued our focus on growing the US, and underpinning this, we have gross profit margins that are strong. We're profitable again, and as Chris said, cash neutral in the near term. But fundamentally, we're platform ready, we've got an overhead cost base stable, and we're ready to scale up. Thank you for your time today.
Fantastic, James, Chris, thank you very much indeed for your presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions submitted today, I'd like to remind you that recording the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Guys, as you can see, we had a number of questions submitted through presentation itself and also pre-submitted. So if I may, James, just hand back to you, and just where appropriate to do so, perhaps start at the top, read out the question and give your response, and I'll pick up from you at the end.
Super, yeah, thank you very much. So as Paul said there, we had a couple of pre-submitted questions and a couple of questions that have come through on these. I'll do my best to answer these, and Chris may well help on some of them as well. And if you do think of any other questions as we're going through this, please do submit them. We'll try and make sure we answer them too. So the first question was around, let me read these out as we go along. The first question said, the board claimed the results of the recent requisitions showed that supports current management. Has the board really listened to shareholders' concerns, and what's tangibly being done to address this? So the fundamental question that was asked to the board was about the growth of the business. And for clarity, the board really wants to deliver growth of the business. That is what we're all here to do. There may be questions on how we get there, but the judgment will be based on our results that we deliver going forward. Over the last year, there's been dialogue between the board and shareholders and management, and this ended up with a request for a general meeting on behalf of the requisitioning shareholders that was held last year. On top of this, the board led and delivered a strategic review, the outputs of which we talked through today. So we're not looking to reopen specific arguments underneath this, but as always, shareholders are welcome to provide feedback directly, and all directors stand for re-election on an annual basis. And specifically on what we're doing differently, we're having more engagement with shareholders, including this investor meet session we have today. We're providing greater disclosure on our quarterly trading updates on platform revenue, for example, and extra information on cost and cash flow in this presentation. We're also giving the opportunity for large shareholders, including those who are either supportive or not of the proposal of the board, to have more regular dialogue with the business. And again, if anybody on here wants to have dialogue with us, please always go through the appropriate channels to be able to have a conversation with us. The next question was, how do you plan to generate more revenue from existing customers? What's the upsell? So we look at customers into three buckets really, and it'd be helpful to talk through this. We have those who we won this year, who we consider to be new, We have those we won last year, who tend to be growth opportunities, and those who won prior to that, who are a retention of the base. So when I was talking about this, we will look to really be growing new, as and when it comes in this year. Those who come in from last year, they are big growth opportunities, and we look to scale those. And really the base, we look to be retaining flat, and ideally we can grow. Alongside this, we are also launching new products that allow us to add incremental value to our proposition. So I talked through, for example, Test Your Ad Digital and Test Your Ad Audio. Something I didn't talk about is since then we've also launched something called Test Your Ad Pro Plus. This allows our customers to have additional customization in a repeatable and scalable manner on top of the products that we already have out today. Another question was that in our finals, we stated that small and medium-sized businesses weren't yet ready to utilize the self-serve data platform. Can you expand on the reasons behind this and how you intend to attract these types of businesses? So for clarity, we're very happy to serve these customers, and we do so today when there's demand. What tends to happen is the requirement of, in particular, small customers is their ability to test is very infrequent or low value. So they may only carry out an advertising campaign once every couple of years, for example. So we do so those in a low-cost manner through the automated platform and the automated results platform where they can receive the results too. On top of this, we also, through our partnerships, have an ability to work with these customers and active customers in scale. One of the points we wanted to make is that we won't be investing heavily in SEO and SEM and above the line marketing to attract a group of small customers into our pipeline. And finally, what we wanted to communicate really was that we're focused on targeting the largest advertisers globally. They have the biggest demand and ability to buy from us. And off the back of winning these, we will then also end up serving a lot of small customers too. So if you think about the chart which I showed with the 3 bars of work and that middle point on data and consultancy, that's the sweet spot where you win the really big customers who look to be spending multiple hundreds of thousands of pounds with us on an annual basis. Another question that came in was around AI, and are we using AI to help generate and improve your advice to clients? Is this effective and a potential cost saving on staff? So we've been working with Warwick University over recent years. They're a top global thought leader in AI. And the work we've been doing there is to look at whether AI could in the future replace the need for humans in our market research. So for clarity, as we go out and we look to test an ad, an idea or a brand, the way we do so is by putting it in front of real humans. In the future, there is an ability that AI may be able to replace this. And we've been working with Warwick University to see if we can train AI on our data set, on our database of over 100,000 ads, for example, to be able to learn from this. We aren't there yet, but it's something we continue to investigate for the future. However, I think the second point to this is there was about other ways in which we can use AI. So we've been looking at specific ways, for example, to apply the improvements on our advice, helping the team mine the database of ads for learnings, trends, etc. So this is work that's taking place, and this is really about us creating really high quality outputs from our Improve Your, rather than replacing the way that they're created. It's also worth me saying, even without AI, we have been able to automate some of our Improve Your guidance. So our Express Test Your Ad guidance, for example, can be turned around in under 24 hours, fully automated. Super. I'll quickly look to see if there's any more. There are a few more questions that are coming into the question as we're answering these. How material do we see the new TYA channels, digital and audio, being in the medium term? So I think candidly, digital is a big opportunity. We know that 60% of global ad spend is in digital. And if you look at growth in overall ad spend, you know that this is driving the top line. Within this is probably 2 types of digital adverts that are out there. There are those which are fundamental sort of click-throughs, the big 2-for-1 flashing logo, which you might see on the top of the page in a banner ad. In reality, we're not going to be testing those and bringing in incremental revenue. But when we were at Cannes this year, Orlando Wood, who's our Chief Innovation Officer, was on stage talking about the importance of gaining attention if someone's watching a video in a digital format. And the fact that you need someone to be able to pay attention for at least 2.5 seconds for them to actually pay attention to the adverts, recognize who the brand is, and therefore grow your brand going forwards. So it will be on those kind of adverts in the digital space where we'll be able to add incremental revenue to our offering. Super. I'm reading through these, Chris. Maybe I don't know. Are there any spots that you'd like to answer as well?
Yeah, there's one. There's a couple I can answer. Going forward, what will the margin difference be between platform and consultancy, and what will the mix be? Well, at the moment, there's no margin difference at all, and we're not signalling that there's going to be any margin difference. And that's, well, platform includes the standard consultancy, and non-platform is the bespoke consultancy. And frankly, we price the bespoke consultancy to get the margin that we require, and that is a pretty price inelastic product set, to be honest. So we're not signaling that there's any difference. We make sure they're both equally profitable. In terms of the mix is only going one way. It's already 80-20, platform, non-platform. The customer will decide where it ends up. I think we're saying, James, it's not going to be 100-0 within the next 5 years, but beyond that, who knows?
Yeah.
And then I think this is definitely one for me from Gray. How will you treat SYSTEM1 LLC payments, revenue or extraordinary income? And subject to, I mean, there's none of it, by the way, in FY23 numbers, because we only reached the agreement at the end of June, and there won't be any in Q1 either. So maybe in H1 there'll be a little bit. But where I'd see it coming is in the other operating income line. So in between gross profit and operating profit. And that's where so the biggest component in there at the moment is the rent recovery we get on our old New York office that we're not occupying. That goes in there, and so it's income we receive, but not from selling our products, but from other stuff. But the auditors may have a different view when the time comes, but that's my expert opinion for what it's worth.
Super. And then another question that's come in around our, so would you be able to expand on new client efforts? Are you targeting direct advertisers, agencies, consultancies? And also, given that marketing budgets are static, which budgets are you targeting in the client? Who signs this off, and what's the lead time to revenue? So within the first part of the question, hang on, I think I've just lost it from my screen. The question there was around, the question
has been deleted.
Yeah, apologies, it's just been deleted.
Don't know if moderator, if you can get that question back about the TYX.
Yeah, I'm just going to put that back up for you now. Bear with me 1 second.
Thank you.
There you go.
Yeah, thank you very much. Okay, so are we targeting direct advertisers, agencies, and consultancies? So yes, I mean, fundamentally, we target people through a few different ways. As you said, we are definitely going out to market to target advertisers directly, but we also partner with, and I think the word partner is probably an interesting word that we use for it. So we partner with agencies, we partner with consultancies, and we partner with platforms who showcase adverts online.
May I have your attention, please?
Apologies.
May I have your attention, please? Please take no further action.
Apologies, we have a fire alarm going on in here. It's just a test, but hopefully you can hear me over it. In response to this, so we will be partnering, as we said. So there was a slide I covered off which talked about some of the big people we partner. Apologies.
Attention, please. Attention, please.
So we partner, for example, with the likes of LinkedIn and ICV, who we talked about previously. These are platforms on which we're able to access customers and reach advertisers directly. We also partner with agencies, some of the large global agencies out there. We haven't got any listed on here, but we do have a way in which we partner with agencies, either to work with their existing customers or to be pitches, part of their pitch going forward. We also partner with professional service bodies, or refer to maybe as consultancies in this space. And the second part of the question, in terms of the marketing budget being static, the advantage we have in that space is that we aren't limited to being reflective of how the market grows. So if we were the largest player in the market, we might be very heavily influenced by whether the market is growing or shrinking. However, being a smaller business, we're able to continue to make a dent into that space and grow our incomes on an annual basis. So we've seen, for example, our Q1 trading, which you would have seen prior to this, reflect positive growth despite any headwinds. Super. I hope that was clear, and apologies for the noise behind at that point. So I think that answers all of our questions, unless, moderator, there's been any that have come in while we've been talking.
No, I think you've covered off all the questions you can. Of course, any further questions that do come through, you'll be able to review those and we'll be able to publish responses on the Investor Meet Company platform where appropriate to do so. James, perhaps before redirecting investors to provide their feedback, which I know is particularly important to you and the team, if I could just ask you for a few closing comments, please.
Yeah, of course. I think the big thing for me is that we're onto a space now where we're into execution. We aren't a business which is about trying to define what we need to do in the future. We're really clear on what that is. We've got a really clear product set. We've got a really clear proposition. And for us, it's all about commercial execution now and growing that top line revenue. We are solely focused on that. It's our day in, day out job and what we wake up for in the morning. So I hope when we speak in the future, you'll continue to see that top line revenue growth come through. Thank you everyone for your time today.
That's fantastic. James, Chris, thanks indeed for updating investors today. Can I please ask investors not to close the session? Should be automatically redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a moment to complete and I'm sure it's greatly valued by the company. On behalf of the management team of System1 Group PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good afternoon to you all.